Hi guys, thanks ever so much for joining me. I'm going to talk in this video about the generics of how markets move. If you're thinking about short-term trading or if you're trading already, then you need to know this information. I'm going to go into detail about how markets move, why they move in a certain way, so that you can pick the right times for your trades. Now, we're talking about short-term trading. We could be talking about anything from 1 minute trades to weekly or monthly trades, but we're not talking about investing. We're not talking about throwing money at a market and just leaving it there until the market moves in your preferred direction, which would normally be up, of course, if you're investing. We're talking about short-term trading. So we're talking about buying and selling. That means going long or going short, predicting the market moves. And most people lose money in short-term trading, and I'm going to explain why that is as well. I'm going to probably show you why, if you're a losing trader, why you're losing. And as you probably know, a lot of it has to do with the psychology of trading, and I'm going to explain a bit about that as well. So let's just have a quick look. This is, let's say, these are all that I'm going to draw. They're all templates. They're all price charts. And effectively what you've got with prices, you've got buyers and you've got sellers. And this is, let's say, the where price is at the moment. And now everybody agrees, based on the fact that price is at that point, everybody agrees that that is a fair price for this particular market. Now, when you learn to trade and you learn to assess markets and you learn the technicalities or technical analysis of markets, you can trade any market in the world. You can trade stocks, you can trade, anything, gold, oil, or indices and forex, and you trade them in the same way. And essentially everybody agrees that the current price is the correct price for that market. However, you have a number of people who are sat on the sidelines who are sellers, potential sellers, and you have potential buyers. So we'll put the sellers in red and we'll put the buyers in blue. Okay, so let's just say that based on where we are at the moment, there's a slightly higher number or higher amount of money as well, perhaps, of buyers than there are of sellers. So based on that, they're on the sidelines, they're just watching price, and they're kind of thinking, I'd like to think the price is going to go up. So they're going to wait for an opportunity, see what price does that allows them to buy and make a profit from the market going up. And you've got a certain number of sellers who are waiting for opportunities to sell the market and bet on the market price reducing and therefore making money by going short. Okay, so you've got this. They're on the sidelines. They're not doing anything at the moment. Price is here. People who are already committed in the market, already have money in the market, they have their trades on, their activities taken into account by where price is at this point in time. Okay, now certain things happen throughout the day, throughout the month, throughout the week, whatever time scale you're looking at, that will increase or decrease the number of buyers and sellers, and so that will help price move as time goes on. But at the moment, maybe we've got this scenario. So markets open, and if there are more buyers on the sidelines, then something happens within the market price in order for those buyers to commit their money to it going up. So maybe it goes down a little bit. Maybe it goes down a little bit. The sellers come in, think, oh, nothing's happening, I'll take a short. Or maybe the market on the long run has been doing this. on a higher timescale chart has been doing this, and therefore they wait for the market to open and they go short. But because there's a higher number of buyers, it won't be long before the market starts going up. It'll get to a stage where it gets to a level where there are more sellers on the sidelines than there are buyers, and the price will start to reflect that. It'll start to go down. Okay, so that's effectively how price moves. It moves according to the number of people who commit from their money from the sidelines, either going long or going short, selling or buying. Okay, so what you see on price charts is you tend to see this. Okay, that's an uptrend, and you'll see it in the opposite direction, which is a downtrend. You'll either get that or you'll get it doing this. Not doing a lot. Okay, now don't forget we've got these buyers and these sellers in the background. Now if somebody comes along and says, okay, I'm going to have a look at such and such this market here, I'm going to have a look at this, and they see this sort of price action, then they're probably going to think it's going up, so they'll be adding to the number of buyers in here. Now, because it's at a level up, right up here at the highest it's been to for ages, they might not be willing to commit their money yet, but they'll wait for it to come down and then they'll start committing their money. And because there are more of them than there are of potential sellers, the chances are that prices will go up as a result. Okay, so what sort of things will encourage people to assume a bias in their mind over where the market's going? Well, very often it's the long-term direction of the market. So in the long run, maybe over the last few months, the market's been doing this and it's reached this point here. Okay, so it's reached this point here, which is at the highs. Okay, and maybe it's even broken out above the highs. And when markets do this, or when overnight they move up and break out to highs or break out to lows, then it attracts interest. And it attracts interest in two ways. Some people might think, oh, right, okay, well, it's broken out higher, and I think in the long run the market's going to go down because the fundamentals are that the market's going to go down. Then they'll add themselves to the potential sellers pile, and that will get bigger, and eventually the market will start reflecting that in its price, in that the market will go down. But not until these people are prepared to commit their money, and they'll commit their money when perhaps there's a peak, it really zooms up, and then it starts moving down because the sellers come in and start committing their money, and the buyers who've bought exit, and that has the same effect of reducing the price. Okay, so the chances are that if you're just starting to trade, or if you are losing money, the chances are that you've been caught out by thinking, oh, that's going up, and committing your money here, seeing it go up slightly, or even just seeing it go down straight away, and you look at your trading computer and trading platform and you see that you're losing money, and as it goes down you see that you're losing money, and you think, I'm going to have a losing trade, I don't want to lose any more, and you exit, only to see the market then start going back up where you thought it was going to go, and you're sitting there feeling awful. And that's effectively what happens. Now, if you were prepared to wait, the chances are, because you've already assessed that the market's going up, that the chances are that you would be correct and you would make money on that trade. But the pain becomes too deep, it becomes too painful to hang on, looking at the money in your account going down, and people exit at the bottom. Now, professional traders, the institutions, they know that this happens, and they often take these pullbacks down to a level which they know becomes painful, and it's when it gets down there that they know that the amateurs start bailing out, and they will accept or take the other side of their orders and start going long. Okay, so these are called pullbacks. These are pullbacks, and they're painful. Now, interestingly enough, eventually something happens at the top here. Okay, what happens at the top? It reaches a level where the sellers, because you don't forget, you've got all these people who bought, eventually they've got to take profits at some point in time, and when they exit their long positions, they become sellers, and they become added to this pile here, potential sellers. And when the market spikes up and they're in a nice profit for their trade, they'll exit their trades and the market comes back down, and that's what creates the undulations. But eventually it reaches a level where, you know, the sellers will be, in the short term anyway, will become greater in number than the potential buyers, and that's when the market changes direction. Now, what happens up there is the market starts going down. Okay, so don't forget that you have people in here who, you know, above this level here, people here who bought. They bought expecting prices to go up, and when the market starts coming down here, they're in a losing position. Okay, they're losing money. So what are they going to do? They're going to bail out, they're going to sell, and they're going to sell for a loss. Okay, but then maybe they've got, you know, maybe they understand how the market works, and they wait for the market to start curling up. So it starts curling up again, and they think, yes, I'm going to make money. So they're convinced that they were right at this stage. They're just into profit situation, and they're going to make money, aren't they? Well, don't forget that on the long-term chart, maybe it's been overdone, and there are more sellers on the sidelines waiting to come in. Now, the sellers will wait for an opportunity. What's an opportunity? When you get weakness in here, as it's approaching this top here, you get weakness in the second top, then the sellers come in and they start driving prices down. Now, think about these people here who bought here. They thought prices were going to go up, they thought they were right, and then they're now back into a losing position here. They're back into a losing position, and they're going to exit their trades. They're going to exit their trades, they're going to sell, and they're going to add themselves to this pile here of sellers. And the sellers are going to become, you know, more powerful than the buyers at this stage, and that's when trends reverse. Okay, now when trends reverse at this stage here. Okay, so it goes down and then it goes up. Now, when it starts going down for the second time and it hasn't reached the previous high, you've got what's called a lower high. But you haven't got a lower high, funnily enough, until the price crosses the previous low, and then you've got, because it could always go straight back up and create a higher high. But you've got a lower low here. When the market crosses this low point here, you've got a lower low and you've got a lower high at the same time. And when you've got lower low and lower high, then that means that prices are temporarily at least going down. And that creates a lot of selling in here, and it creates, very often, it creates a big move down. Okay, again, you may have to get that with traders going short there just to convince them. But eventually this crossover point here is very important. Thinking about it in the other direction, let's say the market's going down, going down, going down, and then eventually it makes a higher low, crosses the previous high and you've got a higher high and a higher low, and that might send prices zooming upwards. And that's the sort of thing when you've got a longer term uptrend and prices come down, then very often traders are waiting for a double bottom in here before they go long, and that propels prices above the previous highs. And so the sort of thing that you're looking for in these bottoms here is you're looking for spikes. Okay, so spikes, and you're looking for big bull bars. Okay, so that would be blue or green, big bars. And if you get a combination of the two, then even better. So what you've got is you've got a market that's undulating, and it's undulating because the buyers and the sellers are changing in number. This is, this is reflected in the volume and the volatility as well. Volume and volatility are somewhat correlated, and what you find is that when the volume is high, the volatility will be high as well, and markets create interest when they get big movements overnight or they get breakouts. These numbers will increase and the volatility will increase, and traders seek out markets with lots of participants. That's what traders are looking for, and you get this type of movement. Now, that type of movement is fairly predictable. You may need, when the market goes up, you don't know how far it's going to go up. When it goes down, you don't know how far it's going to go down, and that's the challenge. But the things to look out for are in the detail here are where are we in relation to previous prices? That's the context. The content is, what the candlesticks looking like in there. Do we have spikes? Do we have big bull bars? And if you have, then that might be the time that the buyers look to get in. When people have bought down here and the market does this, and they haven't, let's say they haven't sold that position, they're in the money, which means they've got more money or they'll be prepared to commit more money. And that's when traders take 2, 3, 4, 5 different positions because they're in profit already. So they know that even if the market goes down slightly and some of their later positions are losing money, that overall the trade will have been profitable for them. So what they don't do is they don't look at themselves in a losing position and go, I'm going to add more. They don't do that. They will wait until they're in profit, and then they will add more money in when they get a good value area. Okay, so current prices reflect what's happened in the past. Future prices will be reflected, or will reflect the amount of buying and selling interest that exists right now, and you're not going to know the interest until the orders have been made in the future. So one thing follows another, and the art of trading is to analyze the details within the charts so that you've got a good probability choice as to which direction the market goes in. That's the skill, that's the art of trading, and this is how you will assess it. So let's just clear this off. How do we go about doing this? Well, first of all, in order to gauge the buying and selling interest, you have to look on the longer term. If you're trading the 1 minute, the 5 minute, 15 minute or half an hour charts, look further back. Look at the daily, the weekly, the monthly, and what's the market been doing. If it's been going like this, then what's happening is that on the short term, the sellers that are outnumbering the buyers are waiting for pullbacks. They're waiting for good value before they enter the market and sell more. That's what they're waiting for. And that's the bigger picture. That's how you gauge interest. You know, in comparison to, you know, if you're looking at individual stocks, in comparison to the competitors of this particular company, how's the share price doing? Is it higher? Is it lower? If it's lower and the market's been going up and theirs has been going down, then why is it? Because if there isn't a good fundamental reason for it, the chances are that eventually they're going to catch up and people are going to cotton on and it's going to start going up. And when it's at a low value compared to its competitors and there's no good reason for it, then it's going to start attracting attention of the market, of all the people who are looking at markets when price starts going up, and the buyers are going to start outnumbering the sellers, and that's going to propel the market upwards. Not all in one go, and if you enter in here, you've got to be very brave. Wait for the market to put in a higher high and a higher low, and then you can start looking for opportunities to enter the market. And you enter, as I said, you know, think about candlesticks that have tails on them. Think about when you're going long, think about the big bull candlesticks that appear in these bottoms here, because that's an indication when the bulls start forcing the market up with big bars. That's the indication that there's a lot of interest in buying and it's not going to go away soon. And you might want to wait for two of these bars, one here, maybe one here in the dips, to take your opportunities. But that's a finer art, and I just want you to understand how the market moves during this video, and then we can move on with some proper training, some proper coaching. Join us at Excellence Assured Trading Academy for that, and get to understand more about the type of trading that's going to suit you, and devise a trading plan that meets your financial needs and your goals and desires for what you want for yourself in the future, your lifestyle. I hope that you found that useful. That's an introduction to how prices move. That's an introduction. Now, bear in mind that when I showed you these moves here, so that is a double bottom, that's a double bottom, and this is a double top. Okay, that's a double top, and they're traditional chart patterns that have specific plays associated with them. There are triple tops, triple bottoms, and very much they're all a variation of another. You don't always have downtrends, you don't always have uptrends. Sometimes you have basic ranges, trading ranges where the market's not doing anything, but that's when you need to look at the long term, because in the long term, if the market is going up, then you've got a period where it's like that. The chances are it's going to be followed by another, this is an initiative move, pause, initiative move, pause, initiative moves, pause. That's how markets work. I hope you found that useful. My name's Anthony Beardsill. Join us for more videos along the same lines on the YouTube channel sometime soon. Thanks ever so much for joining me. Have a great trading week. Bye for now.